Right now, a tiny group of unelected officials controls the exact cost of your rent, the value of your savings, and whether your country's economy lives or dies this year. They don't run governments. They run the central banks in Washington, Frankfurt, Tokyo, and London. And when they alter a single decimal point behind closed doors in a meeting the public never sees the transcript of, they aren't just tweaking interest rates. They are repricing global reality for every person on the planet who has ever borrowed, saved, or spent a single unit of currency. A single policy shift in Washington can instantly bankrupt a business in Karachi or trigger a violent currency collapse in Buenos Aires, leaving billions of people across dozens of countries to suffer the consequences of a decision they had zero say in, made entirely by officials they never elected and can never remove. We are taught to believe in a global free market, priced by supply and demand. But behind the curtain, it functions exactly like a cartel. A small number of players coordinating the price of a single essential good the entire world depends on. But the traditional playbook this cartel has used to control the world for the last century is burning out. The global financial plumbing is becoming too volatile, too fast, and too complex for human minds to manage. Because right now, underneath the visible cartel, an automated layer of artificial intelligence is already taking over macroeconomic forecasting, and it's about to strip these central bankers of their power entirely, rewriting the rules of money forever. But to understand how this matrix breaks, we first have to look at how the cartel operates today. Start with why this works at all. In July 1944, delegates from 44 nations met at Bretton Woods, New Hampshire, and pegged their currencies to the US dollar, with the dollar alone pegged to gold, the same conference that created the IMF and the World Bank. In August 1971, President Nixon severed the gold link entirely, the so-called Nixon shock. The peg to gold disappeared overnight. The world's habit of pricing trade, debt, and reserves in dollars did not. And 50 years later, it still hasn't. Today, roughly 90% of all global currency trades still involve the dollar on one side, and it makes up close to 60% of global central bank reserves. Governments and corporations across the developing world borrow in dollars by default because dollar debt is cheaper and investors trust it more than most local currencies. A French finance minister once called this America's exorbitant privilege. Everyone else on the receiving end simply calls it the leash. Here's the mechanism BIS economists call the global dollar shortage. When the Federal Reserve raises its rate, holding dollars suddenly pays more than holding almost anything else. Investors worldwide pull capital out of emerging markets and park it back in Washington and New York, draining liquidity from countries that had absolutely nothing to do with the decision, purely because their debts, their trade invoices, and their reserves are priced in a currency they don't control and can't print, regardless of how disciplined their own domestic monetary policy actually is. Economists have a name for the trap underneath it: original sin, a term coined at the turn of the century. 20 years ago, nearly all emerging market debt was denominated in foreign currency, mostly dollars. That share has fallen to around 60% today, as more countries built local bond markets, but it's still the majority. When the dollar strengthens, the local cost of servicing that remaining debt rises overnight, with zero change to the country's actual economy, actual output, or actual productivity. Between March 2022 and July 2023, the Fed raised its rate by 5.25 percentage points, the fastest tightening cycle since Paul Volcker's in 1979 and 1980, and more than double the pace of the 1994 cycle that preceded Mexico's tequila crisis. Every one of those decimal point votes happened in a marble room in Washington. Every one of them rippled outward into a rupee, a peso, a lira, a rand, a rupiah, without a single ballot cast anywhere else on Earth. It's not an equal partnership, and the other central banks know it. If the European Central Bank, the Bank of Japan, or the Bank of England refuse to match Washington's moves, their own currencies get pulverized against the dollar. Pricier imports, faster inflation, capital fleeing toward the higher US rate. So almost every time, whatever their own domestic economy actually needs, they follow Washington's lead within weeks, sometimes within days of the announcement. Since October 2013, the Fed has run a standing, unlimited swap line with exactly 5 other central banks: the ECB, the Bank of Japan, the Bank of England, the Swiss National Bank, and the Bank of Canada. Before that, the arrangement was temporary, renewed crisis by crisis since 2007. It's a private club of 6, built to flood the system with dollars the instant any one of them needs it. It's been activated in the 2008 collapse, the March 2020 dollar panic, and in 2023, when the Swiss alone drew $60 billion overnight to contain the fall of Credit Suisse. Nobody outside the 6 was invited, and nobody outside the 6 ever will be.
Now watch what happens to the countries left outside that room. As the Fed tightened through 2022, Pakistan's rupee fell from 178 to over 280 per dollar in under a year, a collapse of more than 55%. Foreign reserves crashed to a 4-year low of $6.7 billion, barely 5 weeks of import cover, while floods and political turmoil compounded the damage. Pakistan's real economy hadn't collapsed. Its currency did, in large part because its debts were priced in a decision made 8,000 miles from Karachi by people who had never heard of the crisis they were about to cause. Argentina tells the same story from a different angle. Decades of dollar-denominated debt left the peso exposed to every swing in U.S. policy. In December 2023, the incoming government devalued the peso by more than half in 3 days, moving from roughly 400 to 800 per dollar. And annual inflation hit 211% that year, later peaking near 292%. The debt was Argentine. The currency it was priced in was not. That mismatch is the mechanism, replayed country after country, decade after decade, regardless of who is actually in charge in Buenos Aires.
Here's the vulnerability sitting inside the cartel itself. Central banks make these decisions using lagging indicators: last month's inflation report, last quarter's jobs numbers, data that's already weeks old, sometimes revised twice by the time a committee even sees it. 6 or 7 people voting on stale information on a rotating schedule of 6-week gaps between meetings are steering a real-time global system using what amounts to a rear-view mirror. AI doesn't wait for the mirror. In January 2026, the IMF published research using machine learning and satellite nightlight data to estimate Venezuela's real GDP in near real time, because Venezuela's own central bank had stopped publishing reliable economic data back in 2019. The model didn't need Caracas's permission, a press release, or a committee vote. It just watched the lights from orbit, ran the regression, and produced a number the government itself couldn't, or simply refused, to provide to its own citizens. Bloomberg Economics now runs language models that read every Federal Reserve, European Central Bank, and Bank of England statement the moment it's released, converting the tone of the words themselves into a forward-looking policy index, live on trading terminals, faster than any human analyst can finish reading the transcript. Hedge funds run the same playbook privately, scraping satellite images of parking lots and shipping ports, and even tracking ship-by-ship cargo movement to estimate consumer spending and global trade before governments publish a single official statistic.
None of this required a vote, a treaty, or a seat at the 6-bank table. If a machine can forecast a currency crisis before a Basel dial ever gets adjusted or a committee ever convenes, the committee isn't actually setting the price of money anymore. It's confirming a price an algorithm already found, minutes, days, or months earlier. That's the actual coup here. Not a takeover by force or by vote, a takeover by pure computational speed. For professionals inside finance, this means the signals you were trained to trust, CPI prints, payroll reports, committee minutes, and press conferences, are already the second fastest read in the room, arriving weeks after the fact. The models reading satellite feeds, shipping data, and central bank language in real time are the first, arriving in seconds. Knowing both, not just the official one, is what separates being ahead of a repricing from finding out about it on the news like everyone else.
For individuals and businesses holding debt in a currency they don't control, or savings in a currency someone else can devalue by a single vote in a room they'll never enter, the exposure has never been more visible or more trackable in real time. For builders and operators, the opening is in exactly that visibility. Independent nowcasting tools, real-time currency risk dashboards, and alternative data platforms built specifically for the people the Six Bank Club was never designed to protect or even notice existed. The analogy isn't a new central bank joining the cartel. It's closer to what happens when a faster trader shows up at an exchange that's still running on hand signals and a bell, and simply starts filling orders no one else saw coming. The cartel isn't being voted out, sued, or regulated away. It's being out-processed, one satellite pass and one language model at a time, by systems that were never invited to the six-bank table and never needed an invitation to begin with. The Federal Reserve, the ECB, the Bank of Japan, and the Bank of England will keep meeting. The swap lines will keep flowing between exactly 6 of them. But the price of money is no longer being discovered only in that room. No one elected the committee that sets it, and now that committee is racing an algorithm that was never elected either and doesn't answer to anyone at all. That was it for today's video. I hope that you not only enjoyed it, but learned a thing or two as well. Subscribe so you always know where the world is headed and what actually goes on behind the curtains. Take care, and I'll see you next time.